Ready with our first session. Agile collaborative models that drive innovation, foster growth, and deliver enhanced customer experiences between incumbents and fintech firms. So let's learn about one such model in this session, co-lending and securitization. We have our moderator amongst us, Singh, Jaini, the founder and CEO at The Digital Fifth. And I do request you to kind of give him a round of applause and welcome him up on stage. Thank you so very much, sir, for joining us. And please do join me in welcoming all our esteemed speakers up onto the stage. I'd like to welcome Mr. Puneet Gupta, co-founder of Kaleidofin. A round of applause and let's welcome him up. Thank you for joining us, sir. I'd like to welcome Mr. Nirav Choksi, the CEO and co-founder of CredAble. Thank you very much for joining us, sir. I'd like to welcome Mr. Vineet Sukumar, founder and managing director, Vivriti Asset Management and Vivriti Capital. Thank you very much for joining us, sir. And finally, I'd like to welcome Mr. Shivashish Chatterjee, co-founder and joint managing director, DMI Finance Private Limited. Thank you very much for joining us, sir. And with that, I hand over to our moderator, Mr. Samir. All over to you. Thank you, sir.
Thank you. Thank you. I think this subject is typically very dry, and we were scared that how many guys we'll find inside the room. Good to see many of you here. Since the subject is tough, and my own knowledge in this area is not very high, I'll use help of each one of the panelists here who are stalwarts and know this area really well. But if you look at the background side, co-lending is something which has come up in last 3-4 years really well. Once the regulations came up, it started on its own. Of course, co-lending structures have taken its own time because of the tech stack issue. It's not a business issue because everybody would love to do more transactions around that. But with time, what we've realized is that without a tech stack coming up, very, very difficult because systems don't talk to each other. They have to ensure that the accruals are done properly, disbursements are done properly, on time, and you can't have a wrong classification on either side. Customer communication structures are obviously has to be taken care of. Reporting on bureaus also are typical structure issues which we may get. So I think what government has done post the liquidity challenge in, I think, 2018 has been substantial, and we see progress. We are yet to see potentially a movement like UPI there because growth will happen, but we need to see somebody building a stack of that stature and quality, and also build standardization there so that ecosystem can actually talk better. I think RBI is building up something like that. Maybe at some point in time, they have a stack like that on which every entity can glue on their own platforms and APIs. It'll work. Otherwise, each LOS and LMS work differently. On the same side, on the other side, if you look at securitization, I think has been in place for ages, right? But I remember my days in banks, it was running off Excels, right? Such a large portfolio running off Excel is dangerous, but that's what was happening. I think regulator is also pushing for that to be automated and improved upon, and daily reporting has to be brought in. I think there's a lot of progress on that side, but still more to be done. I'm sure there are risks which are inherently there on the lender side when the deals are securitization is done, but the transaction data moves late and classification happens incorrectly at times, right? So I think that's the thought process. So I think before we start, as we start, I think I'll take first round of session with the eminent speakers here, just taking their first pointer on the subject, and of course, quick introduction from their side as well. So you can start on this side with Shay, please. Quick introduction and first pointer on securitization and as well as co-lending.
Thanks. Thank you, Samir. And good morning, everyone. I'm Shiv Chatterjee. I'm one of the co-founders of DMI Finance, which is a Delhi-based NBFC. And we are largely a digital lender in the consumer and SME space.
Maybe you can quickly talk about a bit about the subject as well.
Sure. So starting out, I think co-lending and securitization are spoken of in the market as basically two sides of the same coin. And largely that is how it appears to be developing to some extent in India today. But fundamentally, I think I would like to draw a distinction between the two. Co-lending, at least the way we believe it was envisioned by the regulator, was envisioned as a financial inclusion tool. And if you look at the co-lending guidelines, it talks about co-lending between a bank and a non-bank, and it talks about priority sector lending very specifically as what it addresses in the co-lending guidelines. So from a regulatory perspective, it was envisioned as a financial inclusion tool to extend the reach of banks to be able to originate product that they were unable to do so themselves because of a lack of distribution. However, the way the market has developed is it has taken that guideline and it has now extended that and read into it. Co-lending is also applying to NBFC to NBFC transactions and basically extending it beyond priority sector lending. So every asset class is now available, so-called, for co-lending. And the regulator has been silent on this, and so the market has evolved in this fashion. But the result of this is that co-lending has morphed into, from a financial inclusion tool, has morphed into a financing tool for the junior partner in the co-lending transaction. Each of these, whether it be a financial inclusion tool or as a financing tool for the junior partner, has seen a fairly substantial growth in the last several months and will continue to do so, in my opinion. Although I do feel that the risk is that if the financing piece of this becomes the dominant theme in the co-lending market, then eventually it will not have served the purpose of what co-lending was supposed to have done. Securitization, on the other hand, I do believe is largely a financing tool for the NBFC. The big difference is that in co-lending, the originator is basically working on the terms of the senior partner, and the senior partner basically determines what product gets originated, and the NBFC then goes out and uses its distribution to originate that. In a securitization, the originator basically decides what it is that they want to originate. And then they find somebody who is going to invest in this senior piece of the transaction and turn it either into a risk sharing or a risk distribution product or into a financing product.
Thanks, Shiv. Puneet.
Good morning, everybody. I'm Puneet. I'm one of the co-founders at Kaleidofin. Kaleidofin is a fintech platform that largely works with informal sector households. And what we're trying to do is to see that how can we get informal sector households high quality financial services that spans everything from investments, savings, and credit. Talking about the topic on hand, I think we've seen and heard about securitization for a very long period of time. In my past life, I was with a group called IFMR, now called Northern Arc and Dwara KGFS. And a lot of the work, especially around the inclusive finance sector and using securitization, started there way back in 2008. It's a structure which now has established itself quite well. There are clear guidelines to be able to do this. And I think in some ways, it has established itself as a workhorse in terms of making sure that there is freeing of balance sheets for smaller entities, as well as some kind of risk transmission. I would say that there's more that could be done on the risk transmission part. It's starting to become more and more as a balance sheet management tool, but effectively, it is a product right now where I think it requires a little bit more innovation, starting to bring back the entire aspect of risk transmission there. But the good thing is that it's well established, banks understand it, originators understand it, and there is a little bit of that sense of that entire piece in place. Co-lending, on the other hand, is, to my mind, a new and very interesting direction. Enabling regulation is in place. What we like about it, and especially for those of you who are aware about the CLM1s and CLM2s that RBI has come up with, it's actually offered pretty interesting and pretty quick ways to be able to do this, which allow for these structures to be taken up. And there is, of course, a lot of work of technology here that comes into picture, but nothing which is insurmountable overall. The interesting aspect that now needs to be looked at when we start to look at co-lending pieces is really establishment of the asset quality. In securitizations, basically what you're trying to do in some ways is you're establishing a credit quality. There is some kind of a risk participation that comes in. And in co-lending, you have two different entities, one of whom is originating risk and one of whom is a financial investor. And as long as you do not have an ability to underwrite each customer, it starts to become more and more challenging. I think that's where entities like us as Kaleidofin come into picture, where we've come up with a very strong scoring model to say that can we now start to make each individual's credit part very clear, and therefore can you start to work on co-lending in this part. I'm going to stop here, but just want to add one note here. I know a lot of entities here are fintech companies which may not be registered as NBFCs. Unfortunately, both of these structures work only when the entities are able to originate credit on their own books. So when it comes to pure play private limited companies playing the role of a fintech, trying to collaborate with banks, I think both of these structures today do not have any possibility of involving such entities at this point of time. And it's a good start for entities which are structured as NBFCs.
Yeah, maybe all fintechs will become NBFCs anyway. That's what is going to happen, like it or not. Nirav.
Yeah, thanks, Amit. I think most fintechs have realized this.
There's no choice.
10 years too late, right? Good morning, everyone. My name is Nirav Choksi. I'm the co-founder and CEO of CredAble. CredAble primarily is a working capital tech platform. We also have our own NBFC, and we do short-term working capital financing to SMEs in India. For us, I think just to take off on a few of the points that the others made, co-lending is more than just a balance sheet tool for us. I think the way we look at it is co-lending would enable smaller NBFCs to originate better assets because it gives you a pricing advantage. If you can get a lower rate as a combined offering, you are able to then originate better assets. So that's one way of it. Of course, there is leverage that does come in, and that's particularly helpful for smaller NBFCs. But the co-lending market, if you see today, is growing very rapidly. I think one report that I read, banks have declared 25,000 odd crores of AUM this year under co-lending. The unfortunate piece, though, is that co-lending today is looked at only from a specific product perspective, right? So most of the co-lending that you see, and the same thing applies for securitization, is around term loans or longer tenor, EMI-based products. You don't see too many examples of short-term working capital financing or innovations in the product space around securitization and co-lending. Globally, you see things like data-based or data analytics-based securitization co-lending models. You see green assets being originated under securitization and co-lending. Short-term working capital supply chain financing is very big globally, right? To be able to sell it down as securitized assets. I think in India, we are probably one of the few players who has done that successfully from a securitization perspective, to take a sub 90-day paper and sell it down. So while I think early days for co-lending and securitization in one sense, there is humongous potential in terms of what is possible for different kinds of products within both of these verticals, and that's what makes it very exciting.
Thank you. Thank you. Vineet.
Thank you, and glad to be here. I'm Vineet. I represent Vivriti Capital and Asset Management. We are a mid-market lender that seeks to build access to debt to mid-sized and mid-rated corporates and NBFCs. We are a $1 billion book, and roughly around 40-45% of that is in the financial services sector. So we are a very, very active player on both co-lending and securitization, and therefore right from co-lending a 15-day loan to creating a global fund for securitization, we have covered both extremes of this. I think the topic is super interesting because fundamentally, while co-lending and securitization both seem like off-balance sheet financing for an NBFC, but in reality and implementation, they could not be more different. One creates marketable security, one is a bilateral loan contract, and therefore the pools of capital looking at this are diametrically different. There are capital market players on one side, mutual funds, international investors, banks, treasuries. On the other side, it is about a bilateral engagement between a bank and or a large NBFC and a smaller NBFC. The kind of history created is very different. Co-lending creates a history only within that community. Securitization creates a much larger track record which can have an outsized impact on the company's own brand. Having said that, co-lending clearly gives today capital relief to the originator versus securitization sadly does not. And therefore, I think from our perspective, our engagement with the ecosystem, policy, regulator, etc., has been to kind of look at this as solving two very different problems and treat them differently. I'm sure we'll cover some of that during our session.
Thank you. Thank you. I think one challenge in credit has always been that from a regulation and standardization perspective, there are no products built around that. We have scenario where you can buy MF the way, mutual funds the way you want, wherever you want. Structures already built for, there are multiple entities who provide standard APIs and structures for that for ages, right? It's not new. RTGS was built as RTGS with standardization all on board. Credit card became credit card because it was the way it was built. But on the pure lending side, we've never done any standardization, did not qualify that how should the product be. And therefore, it was left to the market to build whatever it is. Now, what it does for the market is structures are difficult to comprehend. Everybody builds the way they want to build. Processes are aligned to each entity. So what if each of these products which we are right now getting into co-lending or securitization had inbuilt standardization on the rates, structures, processes, even the fact that how interest can be charged. I think that would have given more clarity to the market. At one point in time, we were talking about that India will have one more alternative or a couple of more alternative to NPCI. But what we needed in India was largely a lending corporation of India, which would build alternative products around that, or not alternative, but at least a standardization and ability to transmit the transactions across entities at scale. And that's when and you can also put a lot of controls with it when you put that kind of structure where this entity will ensure that transactions are done properly. If there is anything which is not correct, they will audit and track. I think that is maybe next 3 to 5 years, that direction will, if the regulator and government takes, I think that will help a lot to the market. Otherwise, we will keep figuring out where the fraud has happened, issues have happened. People will put FLDG on top of this and that. They will keep doing it if there is no entity like that. So I think that's my thought process at a broad level. Otherwise, we'll keep making mistakes. But I think, Shiv, from your perspective, co-lending has been in progress and you have been engaged into it at a scale at which you have been one of those persons who have been building the market on the fintech side at scale. You have supported so many, and of course, co-lending side, you would have had deep experiences. So how should lenders, both on NBFC side and bank side, both sides, how should they look at it? How does it help NBFC to leverage their books better? And any other thoughts which you have on co-lending, that would be great for us to have.
Thanks, Samir. So I think what I would say on co-lending is it is a very powerful tool. And I think as was mentioned earlier, maybe Puneet said that this is an exciting time, which gives an additional powerful tool to the community. However, that tool can always be misused. And so what I had earlier said, that co-lending, from our perspective, really should be used as a financial inclusion tool and not as a tool for introducing hidden leverage into the system. And so the growth that we would like to see in this sector is really between entities that are originating because they have the distribution and they have the reach, entering into co-lending partnerships with entities that have the balance sheet to do so. And the intention of this piece of regulation is not, in our mind, is not that the smaller entity or the originating entity now suddenly gets to originate a better asset quality. In our mind, the asset quality is going to be determined by the two counterparties, right? And whatever is the pricing of that asset is the pricing of that asset. And both parties are supposed to share that pricing pari passu. There is a service being provided by the originating entity, which is an origination service, maybe a collection service, maybe a servicer function in there as well. And there is a price associated with each of those services. So origination has, has a fee associated with it. Servicing has a fee associated with it. Collection has a fee associated with it, right? So if you're originating at, let's say, 15% for argument's sake, the thinking should not be that, oh, I'm originating at 15%. Let me find a co-lending partner who is willing to give me balance sheet at 10%. And hence, I can now carve out a 5% or 500 basis point margin for myself and effectively get balance sheet leverage or operational leverage on my balance sheet. I think the thinking needs to be that I can originate 1,000 of these things. I only have the capacity to house 200 of these. How do I find somebody to take the balance 800? And then separate out the service provision, which is the origination service, the servicing function, and the collections function, and price that at arm's length. And if that is priced correctly in a functioning market, then there is not going to be arbitrage profits left over in the pricing of those functions, which allows the smaller entity to create balance sheet in a way that is not visible or that is not transparent to the regulator. Because if the market heads in that direction, then I think the regulator will come down and shut it down. Because the number one thing that the regulator is concerned about, among things like customer satisfaction, is the introduction of hidden leverage into the system. And so co-lending should not become a tool for introducing hidden leverage into the system. That would be my biggest concern in how this ecosystem might develop.
So I think you spoke about primary focus of co-lending was inclusion. Maybe it'll be good for us to understand from your perspective, as you run an inclusion-focused entity, do you see an impact of that? Do you see progress there? And also, how does it impact the microfinance industry as such, which has been working in the direction as well? So do you see any change out there?
I'm going to start by saying something a little controversial. I think we are a country which is a very, very large country. We all feel that there are two worlds here, which is inclusion. My sense is we are largely a country where the business is only inclusion. We have less than 3% people who are participating in capital markets, similar number paying taxes. 80% plus of the country earns less than 25,000 rupees on a monthly basis. And the moment you start to look at the markets are very large the moment you get into inclusion. The markets are extremely saturated when you look at everybody else. Yes, there is of course room to grow, and we can see all the UPI transactions and what is happening there. But we are largely an inclusion market. The challenge that you start to see, and this is like a little bit of, as you see it, you kind of get a sense of this. 85% plus people today in India are dependent either on their own wages, which is they're largely self-employed, or they're dependent on somebody else who's self-employed. When you contrast this number in US, that number is 6%. When you contrast this number with many European countries, that number is 16%. The effective implication of this is that for most people in this country, even to earn wage labor, you need to invest in your shop, you need to buy the 2 cows, you need to basically have an enterprise, otherwise you don't earn. And that's what also gets to compete with savings, mutual fund investments by these people. So we are in that situation. What makes it a little bit more complicated is the fact that bulk of this is in cash. And therefore underwriting models become challenging. And that also represents itself as a huge opportunity for entities to say that I can come in, I can actually either come with some kind of a model to be able to underwrite these loans better. I can make some of the information asymmetry transparent. So that actually is the opportunity out there. To my mind, what a co-lending structure does, it allows you to partner with a stronger balance sheet. So you as an entity have a strength in underwriting. You don't necessarily have a strength in a balance sheet. And if you can find that partnership, you actually have the best of both worlds. That basically starts to move the country forward. And similar is the situation with securitization. You effectively then start to find out a way in which you can get your balance sheet to do more. You can rotate your balance sheet a few times over, so your capital doesn't become a constraint in you actually taking models to scale. But a lot of the work that is required at the very, and this is kind of taking a little bit away from co-lending and securitization. I think the big building blocks that we need to build on is high quality origination. And the question that Samir asked me was, how is it going to change the microfinance industry? And I'm going to argue that neither co-lending nor securitization changes it enough. What will though start to change the industry is if we start to think about individuals and not as individuals as a group of 5 people who will come together, co-guarantee each other, and therefore we kind of move forward. It's really recognition of an individual, underwriting at an individual level, that starts to pave the way for co-lending, because now you know that each individual whose loan is being originated with a bank, somebody can actually come back and say, yes, I understand this was a good customer. We're trying to do that through Chi-Score. I know that a lot of entities are right now building out models to be able to start to make that obvious. But I'm very glad that we as a country have today structures like co-lending, like securitization. These are large markets which are already following it. So if you have the right product in the market, my sense today is that there are ways to be able to free up your balance sheet to do a lot more.
Thank you. Thank you. I think, Nirav, you have built an organization which is obviously in the credit side, but very, very heavily tech-led, right? Now, given that the way co-lending works, and there's a lot of constraint on security, on technology side, and now I'm sure security and now that data protection and all of those will also have a large play there. How do you see this kind of framework working out? And also in terms of, is there a play for somebody to build a large tech around that to scale this business? So yeah, over to you.
No, I think, look, both co-lending and securitization from a tech perspective are fairly complex, right? You have two very distinct entities in case of co-lending trying to work together. So your credit underwriting parameters are different. The way you recognize revenue or interest is different. The way you report is different. Now, once all of this comes to a common ground, your technology systems are different. So how do you make that work? So there is, we were having this discussion, Puneet, in the lounge, that there is a very, very strong need to build a middleware which brings it all together. And that's, CredAble's platform is moving towards that for securitization and co-lending. So can we have a common BRE or a business rule engine that will define a product and its credit parameters? Then on top of that, can we have a agreed way of writing back into each other's LMSs through an API integration? More importantly, can you then account it correctly? Third, also can you manage reporting correctly such that a borrower does not, his credit scores do not get affected because of lack of technology for a reason. So I think these are all very large opportunities to make this successful at scale from a co-lending perspective. From a securitization perspective, I think it becomes even more challenging, right? So how do you ensure that you have visibility on the underlying portfolio to investors and doing it at scale? Most of the times you're buying a securitized paper because it's rated, it's originated from someone reliable, but do we have enough data available on the underlying assets? Are we able to run simulations on the portfolio? there are multiple areas where tech can play a major role. And CredAble has been fortunate because we've been working with a very large public sector bank to build out a securitization platform that for them, which essentially addresses some of these challenges. So to answer your question, Samir, I think there's a huge opportunity. If we are going to bet that co-lending and securitization in this country is going to grow, then there's a huge opportunity to build a financial distribution platform and to build it in a way that works both for banks and smaller NBFCs, and eventually for non-lending fintechs also from an origination perspective.
Perfect. Thank you. Thank you. I think we've not spoken much about regulations, and also Vineet comes also from a huge tech background, right? So maybe, how do I see you? Yeah, it's way better. So from a tech perspective as well, right? So one of your entity has done fabulously well on the tech side, UB. So maybe from a regulation perspective, do you see any constraints left, or you think that it's all taken care of, it's about business or market to take care of? And any view on how tech stack can actually help as well, because you have built something around that that's helping the market. Yeah, what do you?
Thanks. I think as far as co-lending is concerned, the market has moved rapidly. Regulations have moved rapidly to build a very strong environment for co-lending to exist and thrive. The starting point was daily NPA recognition, harmonizing direct assignment and co-lending into one single regulation that brought this entire ecosystem together. Making sure that the digital lending guidelines would get harmonized and brought into the public forum with a clear path around it, FLDG capped at 5%, and then finally making sure that there is very clear responsibility for who manages data. I'm coming back to what Shivashish said around disguised leverage. I think fundamentally that has been a problem, and I think what's happened now with this 5% cap is that RBI is very clear that there is an economic capital against an asset, and everybody should be clear who owns that capital, right? And therefore, does it sit with the originator? Does it sit with the investor? Because today the market is getting more complex. There is a company originating. There's a second company contributing 80% of that loan. That second company then sells that loan to a bank under an assignment or a securitization. Now, who owns the asset and who owns the capital against it? Right? Should it really be additive? Should we make sure that we are clearly laying out who owns the capital? So I think some of this is getting clearer by the day. There is still some way to go, but it is getting clearer by the day. And therefore, I think from a regulatory perspective, co-lending is in a good position. And clearly, as you rightly said, UB has done a fantastic job at being the middleware between banks and originators. What we have realized is that this business can only be run if there is complete integration with the LMS and core banking, right? And therefore, more than 130 APIs have to be put into place with each banking partnership. It is an intense work. I think the last integration has taken us 8 months to get done. But that's what is required to take this to scale. But when it comes to securitization, I think while there has been sporadic regulation at 3 instances, 2006, 2012, 2018, somehow strangely 6 years apart. But I think this market has slightly stagnated. We've been at just under 1 lakh crore for 5 years running. Definitely not what we should expect from the Indian economy or from a financing product. And the barriers have increased because, for example, mutual funds, which are a big buyer today, are unable to take credit risk, unable to take structured obligations, unable to house that in a liquid fund. So even if, let us say, a supply chain finance portfolio is originated at A1 plus SO, a mutual fund will find it difficult to pick it up at the highest quality. So on securitization, I think quite a long way to go.
Thank you. Thank you. We'll take some questions from the forum here. Yeah, please go ahead.
Yeah, I'm Anil Tulsiram. My question is to Shiv. Shiv, you have insisted that co-lending, the main purpose was financial inclusion and not financing. But I've heard from a lot of other fintechs and NBFCs that after DHFL and Indiabulls housing fiasco, RBI grew very concerned about the end use of the term loans, because in the term loans you cannot monitor the end use, and in the co-lending the end use can be monitored. So they insisted that the purpose is also the financing part, and RBI gets concerned the moment the funding to NBFC by the banks gets increased. So the only source of funding remains is the co-lending. So why you are concerned that co-lending will increase the hidden leverage, and even if it is used as a financing tool, I think it's better. So why you think it's not better? So anyone else can chip in into this. Thank you.
Thank you. So when I say that it's not intended as a financing tool, if you look at the co-lending guidelines, right, it talks about the purpose of co-lending, and it says that the purpose of co-lending is financial inclusion, and the products that are supposed to be originated are priority sector eligible products. And it identifies that there is the bank involved and there is the NBFC involved, and the NBFC is involved because the NBFC has a wider distribution reach, right? So the regulation is all about financial inclusion. Now, how that setup has gotten used in terms of turning it into a financing vehicle is a different matter altogether, and that's how the market has developed. So when I say that that is not the intention of the regulation, I'm referring to the actual text of what the co-lending guidelines talk about. There are other ways of entering into financing. You don't need co-lending to be a financing tool, right? So what are the other ways? Securitization, for instance, is a bankruptcy remote, non-recourse financing tool. And if you are really thinking about co-lending as a financing tool, then the right way to do it is to figure out a way to get a warehousing line from somewhere and then put it into a securitization vehicle. But I don't think co-lending is where it's supposed to be.
Instruction I've got is no. Yes.
Take one more question.
Okay.
Very quick ones, yeah.
Hi, good morning. My name is Atal Agarwal. I represent P2P lending company, Lending Club. My question is that today we are seeing co-lending, the risk-sharing ratio is 80-20 by and large in most cases. If the ratio changes to, let's say, 70-30, 60-40, will that make co-lending more acceptable to the regulator?
What is the question? Can you repeat, please?
Okay. Today the risk-sharing in co-lending is happening 80-20 ratio, most of the co-lending. In case the risk-sharing ratio increases to 70-30 or 60-40, will that then be more acceptable to the regulator?
I don't think there's an issue with that, but maybe you guys can guide. I don't think there's an issue. It can't be lower than 20.
Yeah, I don't think that's an issue as well. We are fortunate or unfortunate nowadays to have a conference room marked for the RBI in our office. So I don't think that has been the concern. I think it's more about process, data, and effectively how the partnership is managed. RBI is extremely concerned about lazy lending, right? And therefore, it's not about how much skin the originator holds, but the process that the larger entity puts into place. For example, on KYC. For example, on credit filters. For example, on making sure that money is going for an intended end use. For example, tracking actual repayment and not having it bulked up by coming through the balance sheet of the originator. I think these are today far more important questions, and I can say this from personal experience, than really the extent of skin that the originator has in the game.
Okay, I think with this we conclude. Maybe just last one or two points. I think from my perspective, whatever I understand between business and technology, I think lenders know what they're doing and the approach around that. The biggest challenge is the lack of, so the regulations are there to support. Just imagine if UPI came as a regulation saying that you should do inter-entity transactions on your own, and this is how you should do, but specs were not given. UPI would have done 2 transactions in the last, 8 years, right? So that's what I see. So I think 10 years down the line, securitization, co-lending, and more innovations will happen, but run on maybe National Lending Corporation or another new umbrella entity for credit. And that will take care of all these needs. There'll be standardization on products and processes, and maybe the numbers will be alarmingly, or maybe high, but without any regulatory issue out there, because everything can be controlled from a process, but controlled reporting as well. I don't think reporting can be an issue when an intermediate entity tracks that hell out of it. Even KYC process can actually be controlled, underwriting can be controlled. So that's where the world will go. But with this, we pause. Thank you, panelists, for supporting us. Thank you, and thank you for inviting.